A stablecoin is one type of cryptocurrency that is designed to maintain a fixed value over time. The value of a stablecoin is typically pegged to a specific real currency, often the US dollar. In this setup, 1 unit of the cryptocurrency typically equals 1 unit of the real currency. Unlike highly volatile cryptocurrencies, such as Bitcoin, the price of stablecoins is not meant to fluctuate. Welcome to Crypto's Genie. If you like this type of content, make sure to hit that like button, subscribe to our channel, and turn on notifications so you wouldn't miss out on new updates in the world of crypto investing. But recent events in the stablecoin market, namely the plunge of TerraUSD, have federal officials looking closely at this area. Secretary of the Treasury Janet Yellen has cited risks to broad financial stability due to stablecoins, while the Federal Reserve issued a report discussing the uncertainty of what is actually backing stablecoins and the lack of oversight in that market. Here's how stablecoins work, what risks they present, and how to check if a stablecoin is safe. A stablecoin is a cryptocurrency whose value is fixed to another asset, often currencies such as the US dollar or the euro, though other assets are possible. This kind of crypto coin tracks the underlying asset, making its value stable over time, at least relative to the currency it's pegged to. In effect, it's as if the underlying asset has gone electronic, for example, like a digital dollar. Because their goal is to track an asset, stablecoins are often backed by the specific assets they're pegged to. For example, the organization issuing a stablecoin typically sets up a reserve at a financial institution that holds the underlying asset. So a stablecoin could hold $100 million in reserve and issue 100 million coins with a fixed value of $1 per coin. If a stablecoin's owner wants to cash out the coin, the real money can ultimately be taken from the reserve. This structure stands in contrast to most cryptocurrencies, such as Bitcoin and Ethereum, which are backed by nothing at all. Unlike stablecoins, these other cryptocurrencies fluctuate greatly, as speculators push their prices up and down as they trade for profits. While many stablecoins are backed by hard assets, others are not. Instead, these others use technical means, such as destroying some of the coin supply in order to create scarcity, to keep the price of the crypto coin at the fixed value. These are called algorithmic stablecoins, and they can be riskier than stablecoins backed by assets. So why are stablecoins used in crypto trading? Stablecoins solve one of the key problems with many mainstream cryptocurrencies, namely that their drastic fluctuations make it tough, if not impossible, to use them for real transactions. Anthony Citrano, founder of Aquascent, a marketplace for NFTs, recently said, "Digital currencies like Bitcoin and Ethereum are tremendously volatile, which makes pricing things in their terms very difficult. Stablecoins avoid this issue by locking their prices to a known reserve currency. Their stability allows many stablecoins to be used as a functional currency within a crypto brokerage. For example, traders might convert Bitcoin into a stablecoin such as Tether, rather than into dollars. Stablecoins are available 24/7, making them more accessible than cash obtained through the banking system, which is closed overnight and on weekends. Stablecoins can also be used with smart contracts, which are a kind of electronic contract that is automatically executed when its terms are fulfilled. The stability of the digital currency also helps circumvent disagreements that could arise when dealing with more volatile cryptocurrencies. Now, stablecoins don't usually get the same press and hype as other cryptocurrencies, because they don't offer the same type of get-rich-quick opportunity. But here are the most popular stablecoins by market capitalization. Tether USDT. Tether is a cryptocurrency stablecoin pegged to the US dollar and backed 100% by Tether's reserves, according to its website. Tether is owned by Finex, the Hong Kong-registered company that also owns the crypto exchange Bitfinex. Tether was launched as Realcoin in July 2014 and was rebranded as Tether in November 2014. It started trading in February 2015. Tether is the third largest cryptocurrency after Bitcoin BTC and Ethereum ETH, and the largest stablecoin with a market capitalization of nearly $83 billion. USD coin USDC. USD coin is another popular stablecoin that is pegged to the US dollar. It was launched in 2018 through a consortium called Tether that was created by fintech giants Circle and Coinbase. Since then, Coinbase has gone public, and so has Circle thanks to a $4.5 billion merger with Special Purpose Acquisition Corporation, Concord Acquisition last year, which happened just weeks after it raised a massive $440 million funding round. Binance BUSD. Often considered to be one of the leading stablecoins, Binance is issued through a partnership between its namesake, cryptocurrency infrastructure provider Binance, and crypto asset exchange Paxos. It was launched in 2017 and managed to reach a market capitalization of $90 billion in 2021, a massive leap from the less than $7 billion it was worth just a year earlier. As a company, Binance offers various other services in the digital asset space as well, including crypto wallets, savings accounts, and even NFTs, non-fungible tokens. DAI. DAI runs on the Ethereum blockchain and algorithmically attempts to keep itself tied to the US dollar. Unlike centralized stablecoins, DAI isn't backed by US currency in a bank account. Rather, it is backed by collateral in the MakerDAO platform, a decentralized, autonomous organization that also exists on the Ethereum network, allowing people to lend and borrow using cryptocurrencies. So if the DAI credit system gets upgraded or shut down, holders may need to convert their DAI to Ethereum cryptocurrency through the Maker platform, TerraUSD. Reportedly the first regulated stablecoin backed by the US dollar, TerraUSD is among the most famous of all the stablecoins out there right now. Users can invest in it to not only earn, but also hedge against the volatility of any crypto assets they own. They can also trade TerraUSD on dozens of exchanges, markets, and over-the-counter desks around the world, as well as stake, farm, and mine TerraUSD on other 5 platforms like Ethereum, Tron, or BSC. Now there are many different stablecoin currencies, and they are all pegged to the US dollar in different ways. But most can be organized into 3 different buckets, depending on the mechanism used to stabilize their value. Algorithmic stablecoins. These use algorithms and smart contracts to manage the supply of the tokens issued. The system will reduce the token supply if the price falls below whatever fiat currency it tracks through methods like burning or buybacks. If the price surpasses the value of the fiat currency, new tokens will be put into circulation to reduce the stablecoin's value. Crypto-backed stablecoins. These use other cryptocurrencies as collateral and smart contracts to monitor the minting and burning of the coin. This is intended to make the process more reliable, since users can independently audit the contracts. Some of these crypto-backed stablecoins are also run by DAOs, where the community can vote on changes. Commodity-backed stablecoins. Rather than using a physical currency as its peg, commodity-backed stablecoins instead use other assets for their backing. The type of asset depends on the project, though. Precious metals like gold, stocks, and even real estate are all examples of assets being experimented with by these types of stablecoins. Much like fiat-backed projects, commodity-backed stablecoins bring the value of other asset classes into the crypto space. A third party receives ownership of the asset and distributes an equal value of stablecoin to the seller. At any time, that seller can return their stablecoins for the underlying asset at the asset's new price. Fiat-backed stablecoins. These use government-issued currency like the US dollar as collateral. Users can convert from fiat into a stablecoin and vice versa at whatever the pegged rate is. And if the price of the coin falls below the underlying fiat, investors can use arbitration methods to bring the price back to a fixed rate, simultaneously purchasing and selling the same asset on different markets. One of the most common ways to peg a stablecoin is by holding the currency the token wants to peg itself to. Creating a system where users can trade their real-world money for the stablecoin at a 1-to-1 ratio ensures that the stablecoins never produce more tokens than the backer has in holdings. Many trusted stablecoins are fiat-backed. Projects like USD Coin, USDC, and TerraUSD, TUSD use this backing method and have large market caps despite the shortcomings. TerraUSD, an algorithmic stablecoin, was another popular option, but it lost its peg to the dollar in May 2022. This stablecoin used other cryptocurrencies and a sophisticated system of arbitrage to maintain its valuation at the one-to-one level. But the decline in crypto markets and the subsequent loss of confidence in the stablecoin have sent its price plummeting lower. It's important to remember that even stablecoins can be volatile. TerraUSD broke from its one-to-one dollar match and crashed to a low of 30 cents. This led to investors suffering huge losses despite backing a stablecoin. But there is a silver lining among the dark clouds. Tether recently revealed that it will release a stablecoin pegged to the British pound. This move comes as London draws up plans to regulate the fast-growing type of digital currency. Britain plans to legislate to bring some stablecoins under the oversight of regulators, part of a plan to exploit the potential of crypto and blockchain technology to help consumers make payments more efficiently. Hope you enjoyed watching our latest video. While you are still here, please go ahead and click one of these two videos on your screen. Also check out our website and Twitter, links in the description. Thank you for watching.